Good afternoon, everyone. My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly commodity market updates. So, starting with the bullion side of things again, international and domestic gold futures remain range bound while silver witnessed some gains this week. Upside in gold remained capped after last week. Fed Chair Powell reiterated a hawkish stance on the rate trajectory. Additionally, US jobless claims fell the most since 2021. While the US GDP was also revised sharply higher, reinforcing the idea that the Fed will continue its aggressive monetary policy cycle going forward in 2022. However, support after a brief weakness, prices rebounded in the midweek, and support came in the form of easing Fed-favored inflation last week. Even though core inflation remained sticky, inflation eased on a month-on-month and a year-on-year basis. Additionally, manufacturing PMI numbers pointed to the biggest contraction in the factory activity in nearly 3 years and raised doubts over whether the Fed will stick to its policy going forward in July. So, markets were range bound this week. Looking ahead for the coming week, we feel the markets will continue its range-bound activity. Again, the FOMC meeting minutes schedule later in the day will be the key trigger. But most of the markets have already factored in 2 more rate hikes in 2022 by the Fed. But any change in the language in the minutes will be keenly examined. So that will be the key trigger. But after the Fed minutes, we have the non-farm payroll, the JOLTS job opening, and the ISM services PMI this week, and all of them will be a key trigger for the markets this week. So we see markets continuing its range bound price action going forward. On the charts, we feel MCX gold August contract range for this week is anywhere between 57,600 to 59,000, while internationally we see a range of 1895 to 1955 for the COMEX August futures. Moving to crude, both domestic and international benchmarks rebounded from the lows of this week after a surprise cut announcement from Saudi Arabia. Earlier, oil struggled after weak numbers from top consumers. China and US raised concerns of demand. But Saudi Arabia this week announced that it would extend its voluntary cut by another 1 million barrels per day in the month of August. Additionally, Russia and Algeria also pledged to reduce their exports by 500,000 and 20,000 barrels respectively, and this lent some support to the oil markets. Additionally, the dollar was range bound as dollar traders were also awaiting the Fed minutes this week. So markets also found support on the back of range bound price dollar this week. Looking at for the coming week, again, the key trigger will be the economic data coming in the next week or so. Oil prices could continue to face headwinds as economic slowdown could overshadow the supply cuts done by the OPEC, the recent supply cut done by the OPEC. Focus again will be on the economic indicators from China and the monetary policy going forward by the central banks in the few days, possibly in the July month. The trajectory will be important. So that apart from that, we also have the US FOMC minutes scheduled later in the day and the inventory numbers later in the week. That will be the key driver of the markets. According to a Refinitiv poll, US crude oil inventories is expected to witness a draw of about 1.8 million barrels in the week to June 30th, and which would mark the third straight week of drop of supply of our inventories. And that will another drop will definitely lend some support to the crude oil prices. On the charts, we feel NYMEX could remain between $69 to $73 this week, and domestically we see a range of 5650 to 6,000 in this week. Briefly on the gas markets this week, futures domestically and internationally rebounded. In fact, have been gaining for the past 4 weeks now. Again, supported by lower US output, increase in daily amount of gas flowing to the LNG export terminals, and a higher demand outlook. Hot weather conditions, especially in Texas, has prompted users to use gas for cooling, and this too has lent some support to gas prices. In the coming week or so, we see gas prices gain some momentum. Again, we see more uptick for the gas prices, again supported by a decline in production and the anticipated rise in demand for air conditioning for the gas. So we see market remaining on the upside of things, and on the charts we feel domestically we see range of 220 on the lower side to 240 in the coming week or so for the domestic natural gas futures. Finally, on the copper side, both domestic and international copper continue to struggle this week after renewed US-China trade war, dented sentiment. Additionally, worsening growth, economic growth, and amid rising interest rates also weighed on prices. Recent economic numbers from China pointed to worsening condition in the country and largely undermined bets that China will drive demand for the metals this year. So we see further correction going forward. Coming week, we see markets will correct further. Again, focus will be on the minutes of Fed June meeting for more clues on the path of the monetary policy outlook going forward. But markets are already pricing in 90% chance that the Fed will hike in July. So with that out of the way, we see markets remaining focused on the data front. Recent data numbers has definitely suggested a slowdown in the Chinese economy and a slowdown in the US economy as well, and that could continue to hamper any proper recovery for the copper prices going forward in the short term. So we see further correction for copper internationally and domestically. So we see on the charts, we see the copper prices domestically trade between 700 to 730, but a break below 700 will again continue to weaken prices further going forward in the coming week or so. So thank you very much for watching. Have a pleasant day and a week ahead. Thank you.